everybody. This is Dan Sheridan. It's Tuesday, March 14th. The CPI came out today, maybe a little better than expected, and the market is rallied pretty good here. I think the market is more, if you look at a chart of SPX here, if you say, well, why is the market rallying? I think, well, because we, dropped a couple hundred points or so in 3, 4, 5 days, and we were due for a rally. We got down to, as of yesterday's close or so, which would have been Monday the 13th, we were down around that 20% when you look at the highs of January 2022. So right now, the situation is, right now as of 9:15 Central, 45 minutes into the trading day, Tuesday, March 14th, we're about up 62 points, 1.6%, pretty good move. But again, if you look at this, we dropped pretty good at 4 or 5 days, right? So not unusual, as Tom Jones would say. And then VIX is down 3. Again, not unusual. Yesterday, the VIX kind of panicked up a little bit because of the banking crisis. A bit, people were looking for a bit of a hedge there. So now things are coming back. When you look at a 23 VIX, it's still in the upper end of this. If you take out the last 3, 4, 5 days, the 6, 7 week range in SPX has been 17 to 23. So we're still in the upper end, even with us down 3, basically the upper end of the range, other than the last week or so. So a couple things I'm looking at. And again, just want to throw this out as we're speaking. We've been running, we have a new class starting, new class, but it's not really new because we do it every month, the last 17 months. Our most popular class, the 3K class, it's a plan to make 3K on 25K. And it's based a lot on turnover. You're putting on trades, maybe keeping them 20% of the duration. Maybe you're putting on a 15 to 40 day calendar, butterfly, some type of diagonal. And, if it's 20 days, you might keep it 4 days. If it's 10 days, a couple days. And so you're getting some turnover on the same capital. So you're able to get off the same capital, turn over the trades each week. The main thing you learn out of it is risk management. We've been doing it every month. Generally, we'll win 75% of the trades. They're higher, a bit higher probability, or how we trade it is a higher probability. But it all comes down to risk management, and that's really what we teach: the adjustments, the risk management, and the craft. And we put on all live trades. But if today's Tuesday, this is a week off. We're between classes. We just finished the Feb 3K, and the March 3K will start next Tuesday. But if this were class today, generally, which is pretty deep, the main thing you need if you're looking at range-bound trades is not high volatility. Volatility is important, but high volatility for range-bound trades is usually the opposite of what we want, because if you get high volatility, that means the market's moving a lot, right? If you look here, you could say, well, the volatility has been coming up here as we go down. Well, yeah, volatility's up, but it's not range bound. We need some two-way. So at least today, getting some two-way, I'm a little more apt to put something on. So what I'm looking at today is a little more duration, gives a little more price protection. I'm looking at either one of 2 type butterflies. We would call butterfly number 1. So we're looking at April 21, and this is a Democratic voting today. I'm from Chicago. You can vote as often as you want. We're looking at a 38-day trade. This is something I would consider doing today. And we'll call it we'll start out with a 70-70. So what the heck's a 70-70? It's a balanced butterfly. What does that mean? The distance from the short call. So butterfly is you're selling 2 calls You can do it in puts. You can do iron butterfly. They're all the same flavor. But if I'm selling 2 calls at the money, why? Because that has the most extrinsic value. That's the part of an option that decays the most. That's the part of an option that is most affected by volatility, the extrinsic value. Volatility doesn't affect the intrinsic value much. And so here, if you look at, we're basically selling the most extrinsic value, 2 of them, and then buying an in the money 70 points away, out of the money 70 points away as a hedge. That's the basic gist of it. A call butterfly is the combination of a call vertical debit spread 2 times or 1 time, and a call vertical credit spread 2 times. And when you combine them, you get that butterfly. But if I'm 70-70, you can see right now, a 70-70 is going to cost around, let's just say it's $7.20. So $720. This is your graph at expiration in 38 days. This is your graph today, T plus 0 line. And I'm using Thinkorswim on TD Ameritrade Network. You know, there are a lot of good brokers out there. So I'm selling the at the money 39.20 and buying your hedges 70 points up, 39.90, and 70 points down in the money, 38.50. And that gets you just a little bit short delta, very little, minus 1.27. And you can see the T plus 0 line, you're pretty smooth, like a smooth sledding hill in the north, in the Midwest area. On the upside, these would be your expiration break even, where your expiration graph crosses 0. You can see it dips a little bit under as you start getting near there. So you might want to adjust this a little quicker, maybe 39.70 on the upside. But you have room really outside the expiration break even on the downside for a balanced butterfly. Now, if you want to get the deltas exactly closer to neutral, I do either one. I mean, it's like picking vanilla or chocolate or strawberry. It doesn't matter. They're both what I would consider non-directional in SPX, plus or minus 1.5 delta short position-wise. You could also go 70-65. This might be more a conservative way to go. But usually when you unbalance a butterfly, it's going to cost you in capital another 30%. So this would be, if we're going to do it unbalanced, right? That's going to cost you like $985. So another 30%. But that gets the position deltas closer to 0. Here we're less than a half delta short. So I do one of the two, but that's what I'm looking at. A little more duration today, something that takes a, even though the VIX is down today, this is a short Vega trade, so the benefit of volatility goes down. We're still in the higher end of the last 6-7 week range, especially if you take out the last 4 or 5 days. But that's something I'm thinking about. And you know, in class, we'll put these trades on. We'll walk through them. We also have a, you know, when you sign up, and you get information at SheridanMentoring.com for the 3K class next week. For beginners, we have an extra hour of boot camp at the beginning that'll run from 12 to 1 Central, and then the boot camp or the 3K class will go from 1 to 2 Central, Tuesdays and Thursdays starting next Tuesday. March 21 will go 4 weeks. So, folks, that's a little of my 2 cents here. We'll see you next Tuesday in class. Have a great day. Thanks.